time to talk about Cisco Systems. That tech giant has beat estimates for its second quarter revenue and profit, driven mainly by strong demand for its security solutions and an acquisition, a company called Splunk that the company acquired. It's a business and web analytics company. Let's take a closer look at the company and the stock with Brian Szytel, Co-Chief Investment Officer of the Bahnsen Group. Brian, thanks a lot for joining us. You consider this company to be very well positioned in the AI revolution, particularly from a picks and shovels point of view, supplying the hyperscalers with things they need.
That's it. It's that picks and shovels theme. It's the infrastructure behind what will support all of the artificial intelligence and data center build out across the country and across the world. And the earnings beat is reflective of that. The acquisition that Cisco made of Splunk about a year ago is highly accretive at this point, and it's nice to see. We had 117% year-over-year growth in that security segment for the company.
Okay, and what did you think of the most recent results? The market seems to like those numbers.
The market does. I mean, the Cisco was up about 7% earlier in the morning. It's up about 2% now, and I think some of that has to do with understanding that while the earnings beat, we had better than expected top line and bottom line. We got 94 cents a share versus 91. If you were to remove Splunk, for example, the growth was sort of 1%, give or take, and so it was a bit flat, and I think markets have digested that. My comment to that is that, believe it or not, a year ago, those year-over-year numbers, we were still coming off of a backlog of COVID pandemic backlog issues that Cisco was working through. And so the numbers are a little shifted there. But nonetheless, the Splunk acquisition is definitely something that is moving the needle here in a good way.
You made some comments recently in some notes on the stock about its exposure to tariffs, U.S.-imposed tariffs, and perhaps a response from other countries. That's interesting in the context of this company. How is it positioned with respect to potential tariffs?
So the good news the tariffs are an unknown. We don't know exactly what will ultimately be affected. We know what is being talked about, and so what the company has done is in their forward guidance has already estimated the effect of how that may affect revenue overseas. So that's part of what is baked in already to both the stock price and also to forward guidance, and that's a good thing. The other part is Cisco does have a good ability to shift some of their supply chains to offset some of those and to mitigate some of those factors as well. So we still feel confident about the name and about the position. Tariffs, whether they come or go, will be a headwind or a tailwind, I suppose, at this point, but it's not going to shift our thesis in and of itself.
You think it's conceivable the company moves operations into or back into the United States?
Well, doing something like that takes, a decade or more. So not overnight, no. More subtleties, where things can be shifted and where they can make sense to mitigate some factors of potential tariffs. The company's designed and available to do that. Remember, this is a very integrated and global company, so they have operations all over the world. So they have ability to shift where they need to and pivot.
Okay, you mentioned the Splunk acquisition. Tell us more about that. The market seems to like that acquisition.
It does. I mean, this is data collection, data organization, visualization, and analyzation, along with security. So this is very additive for Cisco. It's a high-growing piece. Again, it doubled year over year, so it was up 117%. It's over $2 billion of revenue now at this point, and so on a company earning somewhere around the levels that Cisco is over the past year, this is meaningful, and good to see the numbers start to follow through here.
The company has been a dividend payer for at least 13 years. It has a history of increasing the dividend and also has been buying back stock. And I think there was a recent announcement as recently as today on the company's plans to buy back stock. Yes, $15 billion US added to the stock repurchase program. So do you like the way the company is managing capital in a shareholder-friendly kind of way?
I do like that. We like it a lot. The current payout rate of Cisco is only about 40% of free cash flow. So if you looked at the total amount of dividends being paid out at somewhere around $6.5 billion, you looked at share buybacks now upwards of 15. Now that's doubling from last year. They only bought back about 7.5, a little less than that billion of shares last year in 2024. So that's a big step forward. And the two things I'll say is, one, yes, we think it's good stewardship. But two, we really like to see the growth of dividend. Now, they increased the dividend this quarter 3%, which is fantastic. If you analyze that number, you're in double-digit territory. That's what Cisco has done over the course of their 13 years. They have a lot of firepower and bullets in the chamber, so to speak, to be able to continue to do that with only paying out about 40% of free cash flow. So all those things are very attractive to us as shareholders.